Hi, good morning, ladies and gentlemen. If you take a look at the chat box, we've put up our link to our survey. Just a reminder, this survey is unique to each webinar and will help us to get some valuable feedback so we can help serve you guys better. So, okay, today you can see on the on this slide the agenda for today. We're going to have a S-REIT sector update followed by earnings. An earnings update for Apple and Western Digital, SIA Engineering, and Namly Press Metals. So we're going to start with our US stocks with Apple earnings results first. So our tagline for Apple is they had record high revenue, but is it enough? So just to recap, in case you didn't know, but Apple had their earnings results over the Chinese New Year, and while they had their record high revenue, growing 3% year on year to a record of 78.3 billion US dollars. This is over the last year's quarter one results, 75.9 billion, which was their previous all-time record. We still feel that there's a lot of challenges and headwinds for Apple to continue growing in the future, and we're going to dive a little bit into that. But first of all, why did they manage to have this all-time high revenue? They managed to sell, actually they sold less iPhones than we had originally expected, but they managed to sell these iPhones at a higher average selling price. And the reason for that being that the iPhone 7 and 7 Plus actually had a very favorable showing in the last quarter, and with iPhone 7 offering higher capacity phones, a lot of consumers seem to have been going for these higher capacity phones, which on average cost a little bit more than the usual iPhone prices, as well as the iPhone 7 Plus seems to be getting more and more traction when it's also selling at a little bit higher price than your normal phones. iPhone also had a very good good luck in the sense of Samsung having their Note 7 exploding problem, which contributed to more than average sales for them. Their services also grew by 18% year on year, and this is the 5th consecutive double-digit growth quarter for the services. However, it is the slowest growth that they've had since the services started to grow by double digits. So we'll continue keeping an eye on services because Apple is banking on this to grow quite a bit, and if they are starting to slow down in terms of growth, as you can see from the table, it's nowhere near any ready to take over or at least contribute to revenue in a very significant way yet. So we want to keep an eye on services to see if the growth continues to slow down or whether it's just a hiccup in this quarter. Besides that, they also guided weaker for the next quarter. Revenue, they're guiding for 51.5 to 53.5 billion. This is below our estimates of 55 billion, but you can see that they did that. The reason for this is because of the strong US dollar, and Apple is guiding lower because they expect about 1.2 billion US dollar forex headwind in their next quarter. The strong US dollar actually affects Apple relatively negatively because they do for about 60+% of their revenue is earned overseas. So the stronger US dollar actually causes them to face some forex headwind. Besides that, there's also some positive and negative risks associated with the President Trump's administration. For example, positive-wise, you could, if Trump does go through with his promise to do some tax repatriation reform, then Apple's gigantic cash hoard that's outside the US could be brought back to the US without facing as high a current tax rate as they currently do, which should boost their share price quite a bit. However, negatively, if Trump does end up starting a trade war with the rest of the world and China especially, then you see that it might impede Apple's attempts to grow in China. China actually did fall to about 12% year on year in this quarter, which is another reason why overall we downgraded Apple to neutral. But besides that, the main reason is that the share price has run up quite a bit since we first initiated on it at about $90+. The last close was $129, and our new target price is 129.58. So for the short term, we don't view that there is very much upside. And we feel that Apple should be relatively flat for the next quarter to come. Moving on, our next US counter that we are covering is Western Digital, which had a very good quarter as well. So Western Digital, they actually beat the earnings and revenue estimates, which is why we maintain our accumulate call with an upgraded target price of $84.11 compared to our previous at 71.54. The last closing price was 79.13, and this is actually has run up quite a bit since we first initiated when it was about $62. So overall, the healthier PC market and strong cloud demand helped Western Digital to pull up their earnings. Due to the acquisition of SanDisk, and they've actually managed to have a better product mix as well as product cost control, which allowed them to actually expand their gross margin quite a bit by about 280 basis points. This additional SSD has helped them to be able to price their products better, as well as they are able to earn more per dollar revenue. Besides that, WDC also reaffirmed that they are on track to achieve their targets for synergy in terms of cost of revenue synergies by about US $175 million and US $300 million in operating expense synergies. So that all continues to play in line with what they previously have talked about, as well as our own estimates. So besides that, the cloud and enterprise storage demands has also increased quite a bit by about 12.6% total exabyte shipped in this quarter, and data centers exabytes has shipped about 16.9%. So overall, we feel that Western Digital remains on track, but because of the run up in price, we maintain the call of accumulate with a target price of 84.11. With that, I'll pass on to Richard to talk about his SIA Engineering.
Morning, everyone. This is Richard. Okay, so I'll start with SIA Engineering. Oh, sorry for the typo. This should be neutral. Anyway, our target price has been raised from 328 to 338. Our forecasted dividend for SIA Engineering is 14.5 cents. This would give an implied dividend yield of 4.1% based on the last close price of 352. So let's look at the results. Revenue was down 1.1% or flat. Reasons was it's the same as the last few quarters. Lower fleet management and airframe component overhaul mitigated by higher line maintenance. So this high line maintenance has been a recurring thing. What is happening is because of the less overhaul that's going on in the hangar. More of the work is being done on the line at the apron. Hello, is the volume better now? There's some feedback that is very soft. How is the volume now? Okay, okay, I'll go back a little bit. So revenue was flat, lower contribution from fleet maintenance and airframe, mitigated by higher line maintenance. This higher line maintenance has been ongoing for several quarters already. What's happening is that less of the work is being done in the hangar and it's been transferred out to be done on the apron. For EBIT, you can see is down by 13% year on year, and in fact this year was still boosted by a 4.8 million exchange rate gain. The other thing is associates and JVs also down 4.8%. In this quarter, the JVs was 3.2 million lower year on year, and associates was 1.6 million higher year on year. Okay, reported PATMI headline number looks nice, 6.5% higher year on year. But then if you look, there's actually a lot of one-offs for both third quarter 17 and third quarter 16. So, oh, sorry for the typo here. So this is a third quarter 17, includes a partial gain. And for third quarter 16, there are some one-offs as well, like loss on liquidation of associate, impairment of associate, and dividend from non-current asset held for sale. So if you adjust out all these one-offs here, the recurring PATMI is actually down 8.4%. Okay, so headline PATMI exceeded our expectations through a stronger associates and JV. So for the main contributor to this was JV. There was a 14.3 million contribution. This was a positive surprise because 3 consecutive quarters they had a single-digit contribution, and even with this 14.3 million, look here is still actually 3.2 million lower year on year. So with that, recurring PATMI is still weak. As I point out here for this quarter, about on a full year basis, we're expecting flat 2.3% growth for the recurring PATMI. I've explained this bullet point already, the PATMI at one-offs. And one of the development that was done during the quarter is that SIAEC had signed a partnership with this it's a 49-51 JV, which SIA is holding 49%. This JV is to provide MRO, maintenance, repair, and overhaul services for flight control systems for the Boeing 787 and the Airbus 350. So they have signed an agreement to start this JV, but it's still pending regulatory approvals. Okay, moving on, namely press metals takeaways from the FY16 AGM. So we attended the AGM that was held last month on 26 January. So these are some of the takeaways from the AGM. We left the AGM with a better understanding of the capital budgeting and capital structure decisions of the company and their business plan going forward. So one thing to note, first of all, if you look at their annual report, the largest 20 shareholders now hold 76.71%. This is the highest holding in the most recent 3 financial years. And if you compare between FY15 and FY16, you will see that there's actually new institutional interest among these top 20 shareholders for capital budgeting. So during the AGM, management gave guidance on the capex for this year, FY17. So it was they said that they intend to spend 15 to 20 million Singapore dollars. Bulk of it is to set up its 6th factory in Malaysia. The bulk of this 10 million will go to land and construction costs for the new factory, and between 5 to 7 million will be for new and replacement machinery throughout the group. So some of this 5 to 7 will be for machinery at this factory, and some of this 5 to 7 million will be for new machinery at other of their factory, and as well as replacement. So for replacement, most of the replacement is for their factory that's producing their aluminium product. During the AGM, management was also asked on plans on whether they will consolidate their operations. As you know, they now have 5 factories in Malaysia. So a question was asked on consolidation, and management gave reasons such as country political and labor concentration risk for not doing this. And also in addition, some of their customers actually require redundancy in their production supply chain to ensure uninterrupted delivery of their products. Next bullet point, capital structure. So key point is that, as you know, they actually have a lot of cash on the balance sheet. This cash hoard will continue to be retained on the balance sheet. The management explained that this is a requirement by the major customer to have a strong balance sheet. So major customer is referring to their customer that they supply their specialty aluminum product. This major customer contributes a significant amount of revenue to the group. And in our initiation report, we also mentioned that actually it's a two-way concentration risk as well, because not only does this customer provide a significant amount of revenue to Namli, but Namli is the only supplier for this customer as well. So that's why this customer needs Namli to have a strong balance sheet to ensure that they have they can provide the product to them, because Namli is their only supplier. So in order to pay out the cash, there were 2 suggestions from shareholders. One is to actively do share buyback, and the other is to pay interim dividend. We gave our view on the share buyback. You can refer to it in the report that was published today. Lastly, the last thing is a general stable outlook for FY17. So management talked about 3 different revenue recognitions for this year. First is their specialty aluminum product. They're expecting stable demand this year. For their other project-based revenue, they talked about this public infrastructure facade project. They will be recognizing 80% of the revenue for that project this year. And they also say that there will be contribution from all the other smaller ongoing HDB projects. So we have actually changed our valuation model from a dividend discount to a free cash flow to equity. So where we were wrong previously in our assumption of the dividends, the cash will be retained on the balance sheet, and not all of it will be paid out in dividend. So one thing to note is that Namli has a stable dividend policy, payout ratio of 1/3 of earnings, and this is inclusive of special dividends. So in our assumptions, we have lowered our payout ratio to about 50%, which is in line with the 3-year historical average as well. And with that, we also, because of the lower payout ratio, we have changed the valuation model to FCFE. This would account for all cash that's available to equity holders, both cash that is paid as dividends and cash that is retained on the balance sheet. We have also adjusted our CAPEX assumption higher, in line with what management has guided for that. We've adjusted to 17 million, in line with their guidance of 15 to 20 million, and we've also added a small firm premium to the cost of equity. In conclusion, our target price also has been brought down to 52%, but we still maintain a buy rating. We are based on the 50% payout ratio, we're forecasting 2 cent dividend for this year, which translates to about 5.4% yield based on the last close price of 37 cents. Okay, I'll hand over to De Hong now.
Hi, good morning guys, De Hong here. I will next do a sector update for S-REITs. So I'll touch on what we think will be the outlook for Singapore REITs for the coming year. So as the title says very aptly, Fed normalization of interest rates in 1.7 and 1.8 to end the 7-year outperformance for S-REITs. So in a nutshell, this is what we think. I will go on to elaborate why we think this way. So first up, we we're at the start of a new rate hike cycle. So what we're gonna do is we will take a look at the previous rate hike cycle and we will make comparisons between these two periods. How REITs actually perform in the last rate hike cycle, how were the fundamentals like during that time, and how does it compare now versus the previous cycle. So before I go on to touch on the last rate hike cycle, which was from 04 to 06, we look at the performance of S-REITs over the last 7 years since post-GFC. And you see that if you follow the green line in the chart, you can see that in every single year post-GFC, S-REITs have actually outperformed the STI in every single year except 2013. And 2013 was the year where then Fed Chairman Bernanke announced the tapering of monetary stimulus. So after that announcement, U.S. Treasury yield spiked, and then REITs corrected. And so in that single year, that was the only year that REITs underperformed the STI. Otherwise, over the past 7 years, REITs investors would have done very well. And the major contributing factors to this are, sorry, can you guys see the slides? You can see the slides, right? Okay. So the major contributing factors to these are loose monetary policies and recovering property fundamentals in the early years. We see that from 2009, 2010, 11, the demand for retail property, office property, as well as residential, actually showed a very strong recovery, and that was why the government had to step in from 2010-11 onwards to actually cool the property sector. But for a lot of S-REIT sectors like offices, like retail, you actually see that from the 2009, from the bottom, the market bottom, rentals actually continued to recover until 2014-15. That was around the period of time where we saw the peak in office rents, retail space rents. So this recovery in property fundamentals, as well as loose monetary policies from a few major central banks, your ECBs, your BOJ, and your Fed, actually contributed to this very strong performance for REITs. But what is going forward is that we see the normalization of interest rates and property fundamentals are actually starting to deteriorate. So the previous rate hike cycle from 2004 to 06, we actually saw REITs doing very well. Their returns was a CAGR of 26.5%. This is a CAGR, and this means that this is an annual compounded annual growth rate. It's not the return over the 2 years, it's a yearly return of 26.5%. And this is in comparison with STI's 16%. So you see that in that few years, 05, 06, REITs actually did very well then. And at that point, during that period of time, economic fundamentals, property fundamentals were actually very different from what we see now. You see from the chart, Singapore's GDP at that time, 2004 it was doing 8.8% growth. 05, 06 it was doing 6.6% growth each. So that time and now we are seeing 2014 we had 2.9%. Most recently we have 1.8% for 2016, MTI's projection for 17 is about 1 to 3%. So you see that these two periods of time, there is actually a difference in the kind of growth that Singapore is experiencing. So we think that going forward, there will be two key areas where is going to be the differentiation between then and now. And so the two key buzzwords we think you should take note of is firstly growth and secondly technology. These two are the factors that are going to make a difference in the, the, the fundamentals for REITs back then and now. So we now go into the different sectors for S-REITs to look at how things were back then and how things are right now. So for retail space, okay, before I show you all these charts for the different sectors, you have retail space. I will show you an office space charts as well, and I will show you the industrial space demand and supply chart as well. I think one commonality you will see between all three charts is that if you pay attention to the red bars are actually showing the net demand for the sector across the years. If you look at the red bars across the previous rate hike cycle, you will generally see a common trend in that net demand in those years generally go from strength to strength. So you see retail space 04, 05, 06, the red bar is going up, and that is actually driving occupancy up across all these 3 years. But if you look at the red bars in recent times, you will generally see a similar trend in that net demand tend to be falling, and this demand is falling at a period of time where supply is not small, supply is huge. So for retail, 2016 was the second consecutive year we had a negative net absorption of shop space. So occupancy has been trending down since 2013, and rental rates are going down as well. You see, if you note the trends across the retail REITs, you see CMT, you look at Fraser Centrepoint, the common trend across all these REIT operators, mall operators, is that rental reversions is coming down. Okay, so this is a big contrast to 04 to 06 where net absorption was going up, occupancy was going up. So what is driving this trend is the strong retail sales that we were doing back then. 04 to 06, every single year we were averaging about 5% year-on-year growth. But if you look at the recent trend from 2012 onwards, we had a strong recovery in 10 and 11 post GFC, but then 12 onwards we were doing flat to negative retail sales. A lot of times you look at the headline numbers, they will show a pretty healthy number, but that number actually includes motor sales. If you include motor vehicle sales, the underlying retail sales is actually flat to down. And a lot of this motor sales, firstly, is driven by rental vehicles with the coming online of Uber and Grab. A lot of these motor vehicle sales were driven by them, the rental vehicles. Secondly, a lot of motor vehicle sales was also driven by the renewals of COEs due to necessity. Okay, because on the surface, if you look at car sales, you see healthy car sales, you would have thought it's a sign of consumers doing well, but if you look at car ownership in Singapore, it's actually down. So the picture you're looking at now and the picture that's painted in the previous rate hike cycle is a very different state of the consumers. So something else that is different between that time and now, we think, is that now shopping malls face a lot of new challenges. with technology, there are a lot more new e-commerce sites. Amazon has been around for the longest time, but in recent times, you see Lazada, you see the likes of Zalora, your Love Bonito, your Dressabelle, all these new e-commerce websites will continue to drain money away from the brick and mortar stores. But a key difference between then and now is that not just you are seeing the emergence of all these new e-commerce stores right now, because of improvements in technology, what used to be pet peeves for e-commerce customers, the last mile delivery, in the sense that the amount of waiting time, or in terms of returns, if you get faulty goods, returns is how convenient is it to do a goods returns if you get a faulty online goods delivery. All these improvements in last mile delivery, better usage of the logistics fleet for logistics company, they actually make all this what used to be concerns or inconveniences for e-commerce customers, they actually improve the situation a lot. Like for instance, like nowadays we have a lot of third-party apps. Like for instance, if you go to Amazon, there will be certain retailers where you cannot purchase from if you are from Singapore, and then there will be instances where you need to clock a certain minimum amount of spending before you get free delivery from Amazon to Singapore. But now with Amazon coming to Singapore this year, the minimum amount charged to get free delivery to Singapore, that part would be already negated. And then with all these third-party shopping apps, what they do is actually for certain e-commerce websites where you cannot actually access them, or they do not actually deliver to Singapore, what these apps do for you is that they will actually do the shopping for you. You give them whatever you want, you give them the URL link, and then they'll do the shopping for you and they'll send it to you. These apps are coming on very aggressively. So for instance, EasyBuy for last year's Black Friday, promotions across the board for EasyBuy, for all these third-party apps like ComGateway as well, you see that they offered flat shipping rates of as low as $1.99 US dollar flat, for regardless how big your shopping cart is. So this kind of aggressive tactics to gain market share actually would boost the e-commerce, the flow of customers towards e-commerce. And then now you have a lot of startups trying to optimize the logistics process as well. For instance, we have one Ninja Van. They actually have this IT platform for logistics partners for them to actually better utilize their idle fleet. So you partner with Ninja Van. If you have idle fleet, they can actually push out orders to you. So with this better optimization of idle fleet in all the logistics company, the entire delivery process actually becomes more seamless. And another trend we are seeing on the ground is that last mile delivery used to be a very big problem for e-commerce, but right now you see SingPost setting up all these pop stations. Not just SingPost, other logistics company as well, Takubin, they set up pickup booths in shopping malls. So it's actually getting easier, getting more convenient for these e-commerce sites to do delivery, and the inconvenience for people to go online to shop is actually mitigated. So all this will actually bring more people towards the online scene and away from the brick and mortar. And I think a trend in recent times is that because of e-commerce, a certain trade mix of retailers. I think most notably you have your music and your that's why your HMVs, your bookstores. These are the more likely to be affected by e-commerce in the sense that their product offering is is a standard package. You buy online, you know what the book is, you know what the CD is, you buy online. If you can get it cheaper, there is no way the product can be different from what you ordered. Unlike if you order, like, let's say a fashion, like let's say a top, a dress, the size, it may be an S size, or the fabric may come out different. The entire feel of the comfort of the dress may come out different. So there are certain trade mix that are more susceptible to e-commerce. So what you see recently is that for malls, there's a trend of migration, or increasing proportion of the tenants being in the lifestyle category. Your Starbucks, your Yao Yaos, your all the sit down and chill and relax lifestyle kind of retailers. These are the retailers which are not going to be affected by your e-commerce. People will still go to the mall to chill, to hang out with friends. And the trend in moving towards this is that as you lease out your spaces, instead of leasing out to, let's say, 2 or 3 fashion retailers, you are leasing out to one who takes up a bigger shop space. Let's say if you lease out to NTUC, if you lease out to all these Starbucks, they occupy a bigger shop space. The rent per square foot is usually lower, and depending on the gross turnover component, depending on the sales as well, the gross turnover component for all these lifestyle tenants may be higher, but if sales is not up to expectations, then it may not be enough to catch up to what was previously. You were getting a higher sales, like a dollar amount per square foot, if you are renting a smaller shop space. So now it's very dependent on sales for you to match up to what you were able to get previously. So the traditional anchor retailers were your supermarkets, your F&B, and now with e-commerce, your RedMarts, your Honest Bee, and with Uber Eats as well, Deliveroo, you see that all these traditional anchor tenants, your supermarkets, your F&B, they're not going to be spared as well. So if NTUC is doing more sales online, then probably they may not need that big a shop space. They may just need maybe like 70-80% of what they needed previously. So this is a I think this is a pretty big headwind for the retail sector in my opinion. I will go on to talk about office space for the comparison between now and 04 to 06. So as we've said again, red bars, you see the 3 years for the first rate hike cycle, the previous rate hike cycle. Rising red bars, very strong. Blue bars were nowhere near. So supply was low, demand was high. That actually caused office rents to spike in that period of time of 04 to 06. Office rents actually spiked 49%. So you compare that phenomenon to now. Now you look at the red bars, it's been falling since 2011, and this fall is to make things worse. This fall is on the back of huge supply that's going to come in. In 2017 and 18. And then I think for office space, to make things worse, we have a lot of even within Singapore itself, we have this government trying to encourage decentralization of office space. They want to ease the congestion in the CBD area. So you have business parks set up. We saw Google moving out to Mapletree Business Park with a very huge office space. And then we have a lot of technology as well, which I'll touch on later, that could potentially affect office space demand as well. And I think for industrial, not a different story. You see 2016, generally demand is slow, supply is pretty huge, especially for warehouses and factories as well, with the exception of business parks. Business parks supply over the next few years is pretty low. It's pretty low, so we expect the occupancy to slowly creep up for business parks. But if you look at 04 to 06, you look at the rate bars again, strengthening rate bars, supply was nowhere near. So you see this period of time, occupancy going up, but then contrasted to now is actually a very different story. So the argument can be that, okay, growth back then was stronger. Growth now is not as strong. Growth now is weak. But the argument on the other side could be that, oh, it could already be in a price, right? Because if you look at what CMT was trading before the GFC, during 2007, CMT was doing as low as 2%, 3%. It was doing, even the yield for Capital Mall was even lower than the government bond yield. And right now we're having a spread. CMT is doing like 6%. Our 10-year bond yield is like a 2.3%. So we have a spread right now. So you can argue that, oh, you know, is weak growth, but it can already be in the price. So we will touch on this in the next slide to argue why it the probability for upside is actually less. So first, before we do that, I will actually compare now to 2013 as well. 2013 was, remember, that was the year that I said was the only year that REITs did not outperform the STI in the 7 years post GFC. So what happened that year? That year was the year when then Chairman Bernanke announced the tapering of monetary stimulus, and following the announcement, Treasury yield spiked, our 10-year bond yield spiked. Our 10-year bond yield spiked to 2.7%. But what happened thereafter is that the bond yield started to trend down again because of the more realistic expectations of how interest rates were going to move. Because back then, even though we were recovering, but we were still weak. You look at the two charts, unemployment rate back then 6.7%, inflation rate versus the Fed's 2% target rate. Back then, we were not quite near. But so that's why high bond yields then did not sustain. But right now, if you compare now versus then, I think we are doing better now. And we have the expectation of pro-growth Trump policies probably and possibly stoking inflation as well. Right now, we have unemployment rate at 4.8%. Inflation rate is not near 2%, but it's slowly creeping up. So we are definitely in an environment where it's more likely that the pace of rate hikes will be faster and probable. And furthermore, our house view is that we think that the Fed is actually behind the curve in raising rates. So the next question could be, so in conventional wisdom, we have it that now when interest rates go up, that generally means that economies are improving, right? Because that is when you need to raise or hike interest rates to curb the money supply, because your economy is doing okay to absorb the rate hike. So why is it that the rate hikes then and now is looking so different? Because right now we are seeing US recovering, and why is that growth not actually coming down to Singapore? And the reason for that is a lot of structural issues within our own country. We have a slowing labor force growth because of the change in government policies after the 2011 GE. We used to grow very rapidly in the early 2000s. That was because we were taking in huge amounts of foreigners. So by virtue of the numbers game, just by virtue of the intake of the growth in labor force, you were able to grow faster. But right now, with the shift towards a productivity-driven growth, as well as now we're facing a different China, China in the early 2000s, they just joined the WTO. They were doing far better, growing far faster. Now, China is facing industrial overcapacity problems. And then we have our typical stronghold sectors over the last few years. We were not doing well on the oil and gas front. Our property were curbed by cooling measures. So there were a lot of structural problems within Singapore itself. Not to mention all the already existent problems like aging population. And to add to that, we have technological advancements now, such as advent of e-commerce. We have now technology that allows for very advanced web conferencing. This allows employees to work from home. And we have now also digitalization of information. So now instead of storing your information in file cabinets, instead of requiring huge storerooms to store your files, you need data centers instead. So all this actually reduce the need for office space, and there was actually a report by this property research firm saying that if companies were able to more efficiently utilize all this office space through this using technology, they can actually cut the demand for office space by 30%. And on top of this, we have the trend that we mentioned before, Singapore's trend, government trying to encourage offices to move away from city center as a way to reduce costs for them as well. Firstly, reduce costs. Secondly, ease the congestion in the city center, and to make the living in suburbans more attractive to people as well. So all these trends actually add up. And now we talked about the yield spread, right? We're saying that now there's actually a pretty healthy yield spread versus if you compare to the last rate hike cycle, when I was saying CMT was trading below government bond yield. So our yield spread now is 3.9%. If I can recap what this yield spread actually means. So this yield spread is what we take the yield for the REIT index, which is about 6.2% now, minus away the risk-free rate, which is 2.3% now, we get a 3.9. This yield spread is actually the increased yield that the REITs offer investors in return for the risk that investors are exposed to if you hold a REIT versus if you hold a 10-year government bond. So our current yield spread of 3.9% is actually very close to the 7-year average of 3.7%. But what we think here is that if you can look at this 7-year period, you can break it up into the earlier part and the later part. We touched on just now that post-GFC in 2010, 11, 12, there was a big improvement in residential markets, and for retail markets, for office markets, it was improvements all the way until 2014, 15. So you see this 7-year period, this earlier part is when office fundamentals were still stronger, right? So driven by stronger and stable office fundamentals, loose monetary policies, REITs should do pretty well. So that is the earlier part, but right now what we are seeing is that property fundamentals are starting to deteriorate. So I think on this note, if you have a period where property fundamentals are deteriorating during this later part of this 7-year period, I think it is not unreasonable to say that yield spreads should continue to trade close to this average yield spread or above, because you are trading at close to this 7-year average, but this 7-year average is taking into account the first part where growth, the fundamentals are stronger. So right now, if you're moving into a period where your fundamentals is deteriorating, I think it makes sense that your yield spread should stay, or if not, go higher. And then So we think that yield spread should stay close to or above this 7-year average because firstly, I talked about the dropping fundamentals, and secondly, with the normalization of monetary policies, rising interest rates, tightening monetary conditions, this actually decreases the appeal of yield instruments. So we are of the opinion that given that our current yield spread is close to the average, we are reasonably priced, we're not cheap anymore, and that is why we are downgrading our S-REITs sector to an underweight. We still have 3 accumulates for S-REITs. We have 1 reduced on cash. Our 3 accumulates are First REIT, Croatia's, and Mapletree. First 2 of which are actually out of Singapore, so not so exposed to the weak fundamentals here in Singapore. And the last one, Mapletree, is the low gearing, allowing it ample firepower, and because of the ability for them to get low cost of financing as well. So low cost of financing and low gearing. And so for investors who are actually switching out of REITs, we have a list of alternative proposals. If investors still want exposure to property-related companies, we have the following 4 locally listed property-related alternatives. Some of them, okay, you have some of them the dividend yield may not be as strong, but then I suspect you will not be very disappointed with the capital gains for these counters if you buy into them. And then we have one last one, we have Centurion, where the trailing yield is decent versus like CMT of close to 6%. That one is doing a 5.6% as well. And on top of this list, we have other counters on our PSR universe coverage that offer decent dividend yields as well. If clients want to switch out of REITs into something with a decent yield, we have ComfortDelGro doing a 4%. We have Cogent, which has a decent yield as well. Yeah. Oh yeah, and Namli as well. Okay, so with that, we've come to the end of our presentation today, and we welcome questions from you. Oh yeah, guys, can please help us to do the survey for this week's webinar as well, because every survey is unique to our every week's different content. So we would like to know what you actually would like us to present, how you find the seminar for the week, so that we can better serve you. Thank you. Hi, there's a question on REITs. So would there be any REITs that would fare better than majority? We think that the reasons why we are still on accumulates for our three REITs, basically some of the things that we try to take note of or we like to see in a REIT in the current environment is that because interest rates are going up, so it will be harder for REITs to do acquisitions if your cost of capital is going up. So firstly, you need to get a REIT where they are able to get cheap financing costs. Not just that, on top of that, gearing must be low enough for them to be able to make equity acquisitions, because we know that if you issue rights, if you issue equity, cost of equity will always be tend to be higher than cost of debt. So generally, if you acquire a property, you use full debt, it's easier to get an accretive acquisition. So we like REITs that have long WALEs, weighted average lease expiries, where the income is fixed for a long time. So that's why you see first REIT, their leases are 15 years. The rents are fixed for 15 years. Escalation is at a preset amount. Escalation is at a pegged to Singapore CPI. So it can only go up. It cannot go down over the 15 years. If CPI is down, you will stay flat. If CPI is good, then rents will go up. So these are the fixed rents actually offer some kind of buffer, some kind of income visibility. Of course, if the economy is very, very buoyant, if rents are going up very fast, then you don't want this kind of fixed rents, right? Because you want the escalation to come in. But then in current climate, I think having fixed rents and the buffer, and then you have pegged to Singapore CPI, I think that's pretty desirable in current times. And then Croatia's as well, their leases are all long. Hi, there's a question on the comparison between developers and and REITs. So given that, why are we more bullish on property developers versus REITs, since developers are also affected by cooling measures and interest rate hikes? So I think with the normalization of monetary policies and interest rates, right? The mentality for investors now, especially in the West, is the switch from defensive plays, because your monetary policies will lose. So yield plays were attractive. With this reversal, there could be a switch from um, defensive plays into growth plays, and then not forgetting that for developers, there is at least a catalyst in sight that when cooling measures are lifted, even though we don't think it will come this year, but then um, probably next year, but when cooling measures are lifted, and eventually they will be, then developers will stand to gain more than REITs. And our call for the various developers that we have on accumulates or buys, they are actually exposed to certain segments in the property sector that we think are already facing close to a bottom in prices, especially like you look at Hobby. They are a lot into the luxury end, the Sentosa Coast and CDL as well. So a lot of these a lot of these high-end properties, the correction in prices over the last few years have been more drastic than suburban suburban prices. So suburban prices is still holding up because we developers nowadays, they are actually cutting up the units into very small units. So you get like more and more claustrophobic units nowadays. But the implication of that is that smaller units mean quantum amount is lower, it's more affordable. So interest rates cheap, investors are still rushing in, supporting the prices for suburban units. But you look at central area properties, their prices have actually fallen pretty heftily. And we are of the opinion that the fall we are actually much closer to the bottom than many people think. So given that thinking, we are bullish on the developers which have exposure to that group. And some of our covered developers, they also have pretty stable income, like Hobie. They have a stable income from Metropolis and UOL Group as well. So you actually get a hybrid of stable income, and then if property cooling measures are lifted, then you get a benefit from there as well.
Hi, this is Richard. There's a question on Namli. How big is the significant customer who has Namli as a single supplier, and how strong is this customer in terms of impact on Namli if they drop off for any reason? Okay, so first of all, customer for this major customer is the one that is buying the specialty aluminum product, which is the aluminum frame for the refrigerated container. Namely does not disclose how big this customer is um, in for their group revenue. But if you go on the internet and you find one of the AGM, there's some disclosure that during the 2013 FY 2013 AGM, they said that that customer contributes about 40% of their revenue. So that is a bit outdated, but that should give you a sense of how big this customer is contributing to their revenue. Of customer dropping off. Okay, so they sign a 5-year contract with the customer. During the recent AGM, it was mentioned that they still have about 2 to 3 years left on that contract. So for now, there's no risk on that. But as you can see, Namly, when they first IPO, this customer has been with them since then, and that's more than 10 years already. So there's it's the risk of losing this customer probably isn't very high, and as I said, Namly is their only supplier as well. So it's a sort of it's a two-way relationship. Okay, so since there are no other questions, we shall end the webinar today. May I remind you to help us to complete our survey for today's webinar as well. I've just sent the link in the chat. So thank you for attending, and see you again next week.